Hello, and welcome back to the CashFlo podcast, where we teach finance as simply as possible. My name is Clint Hansen. I'm currently studying to become a CPA at a top 3 accounting school, and I love personal finance. Today, we're going to talk about the stock market, navigating the stock market. There's a lot of complexity, a lot of jargon, a lot of unique terms, and we're not going to get to all of it today. But if you have any questions, of course, reach out to me in the comments or sending me an email, which I'll leave that down in the description, wherever you're watching this. As always, our goal is to break down finance as simply as we can. So I'll go ahead and try to do that with the stock market today, which might be a little bit of a challenge, but we'll see. We're going to go ahead and start with a review of last week, like we always do. As in, we did that last time. And then talk about some common misconceptions with the stock market. And then dive into what it is, how it works, and some common terms and how to get started a little bit in the stock market. Of course, again, we're not going to cover all of it. And I hope to do an episode about how you can get started and where I would go to get started in the stock market. But this is just kind of to understand the stock market. Let's start with a little review of last week. So last week's podcast, we talked about where to put your money. If you haven't listened to it, I would highly recommend it. And we kind of gave a little preview of what we would be talking about this week. We talked about some common mistakes with where people put their money. First is to not put it anywhere, not invest. A lot of people just keep their money in their checkings or savings account and let it just sit there where it's not working for you. Remember, we want your money to be working for you. I like this phrase that I heard the other day. You should make your money work for you because you worked hard to get it, or something like that. But you want your money to be working for you, and by not investing, you are letting it sit there and not work for you at all. The second thing is to invest too much and not to have an emergency fund. And lastly was to not take advantage of tax advantaged accounts. And that's your Roth, your 401k, and your traditional IRA. We dove into those a little bit. We talked about the 3 buckets, the short-term, mid-term, and long-term buckets. We have, in the short term, your emergency fund. So remember to fill up that bucket as quickly as you can, and to when it starts to overflow is when you should start to invest your money. And that kind of goes along with the midterm as well. You can use the midterm and short term kind of interchangeably by putting money in the short term into a like high yield savings account or money market or CD. In the long term, we want to use those tax advantage accounts as much as we can, the Roth, the traditional IRA, and the 401k, and then investing into the stock market, which is today's topic. And I know that the stock market is a scary thing for a lot of people, but hopefully by understanding it, you can not fear it as much. I wanted to start today with some common misconceptions about the stock market. The first one is that you need a lot of money to start investing. Okay, a lot of brokerage accounts, such as Robinhood, Webull, SoFi, things like that, they'll let you start investing with as little as $1. You literally only have to deposit $1 and you can start investing. That dollar is not going to grow very much. I mean, it could grow a lot, but even if it grew, if you doubled the dollar, all you would have was $2. So it's kind of with everything that has to do with the stock market. Maybe not everything, but it's a lot of high risk, high reward. So the more money that you put in, the more that you will make. But again, you don't have to put in a lot of money to start off with. That's a common misconception is that you have to have a lot of money in order to put money into the stock market. You can start with as little as $1, like I mentioned, buying what's called fractional shares. So fraction obviously means part of. So if you just want to buy a dollar's worth of Apple shares, you can go ahead and do that, or $10, whatever you're comfortable with, and it'll grow. Another common misconception that I often hear is that the stock market is basically gambling. Okay, the stock market is not gambling if you do it wisely. Okay, there are definitely people that gamble on the stock market and kind of use it as a platform to gamble, I guess you could say. Those people are called day traders, or people that like to time the market. So time the market means that you wait for it to go down, and then you buy it, and then when it goes up, if it goes up, you sell it. And so you have to have two really good timing mechanisms. If you can predict the future, that this would be a really good thing to do, right? But you have to know when it's going to go down and how low it's going to go down, and then you have to invest when it's at its lowest point, and then you have to take it out after its highest point. And very few people can do that. In fact, no one really can do that consistently. So that is a form of gambling, I would argue, and it's very risky. But investing is not the same as day trading. Investing is putting your money into something for the long term, something that you think will return your money and more after a period of time. This doesn't require knowing the future because the stock market in general has always gone up. There are times of what's called recession when the stock market goes down, but after those periods of recession, the stock market generally will go back up. So there's no reason to fear the stock market for that reason, and it's not gambling because you're putting your faith in the companies in the stock market that will do well over the course of time. Okay, so it's not gambling if you do it wisely. Okay, another common misconception is you can get rich quick. I don't know about you, but I've heard like 1,000 stories of someone's friend who is this day trader and every once in a while decides to just go crazy and make a lot of money and then pay the taxes, and then they're better off. Okay, some people can get rich quick, I guess, if they get lucky, like we mentioned with day trading, but most wealth is built over the course of many years through compounding. Okay, so and compounding meaning obviously is to make money and then make money on that money. That is done over the course of time. It won't happen just overnight. All right, and then the last common misconception I want to talk about here is if the stock market crashes, you'll lose everything. That's kind of a hot topic right now since the stock market's not doing well. But the stock market has crashed before, and it will crash again in the future. It's not about waiting until that crash and pulling it out right before or even during it. It's about riding the highs and the lows, and we'll kind of get into that. And just don't panic when the stock market crashes. Okay, stick with your investments, and over time it'll correct, and a stock will be worth what it is, and you'll get your money. And we'll talk about all that coming up. Okay, great. So the next thing that we'll dive into is what is the stock market. The stock market, I like to think of the stock market as like a giant farmer's market. Where people go either to buy or to sell some goods that they have, right? You can go and you can sell your apples that you grew that year, or some honey that you made, and people can go to buy it, right? So it's like that, but it's with companies, and it's with pieces of companies. So each stock is a piece of a company. When you buy a stock, you're betting that the company will continue to do well over time and return you that money. Back in the day, they had what's called a trading floor, and on the trading floor, you could go and wave around these pieces of paper. I don't know if you've played the game Pit, but in the game Pit, you're trying to collect certain things, and then you'll go around it. You'll trade with people in order to get all of the same thing. So this was pretty common back in the days. They would go to the trading floor and they would yell out, "Oh, I have 10 stocks of whatever company, Walmart or something, and I want this price." And so people would come over who were interested, and they would haggle over the price until they agreed and make the trade, like a farmer's market. So that's kind of what the stock market is. There's two main stock exchanges in the United States. These days, we don't do any in-person trading. You don't get a piece of paper or anything for buying a stock. Well, I mean, you get some digital documentation, but you don't go around and wave around that piece of paper and ask people if they want to buy it. It's all done electronically these days. There's two main exchanges. There's the U.S. There's two main exchanges in the United States. The first is the New York Stock Exchange, and the second is the NASDAQ. The New York Stock Exchanges, they have what's called blue chip companies. Those are the big companies. NASDAQ is a lot of like tech or biotech companies, and those are both in New York. They've actually been talking about making another one in Dallas, I believe, or somewhere in Texas, but that would be further down the road. And like I said, they used to have a physical trading floor where these things would happen, but now these all happen online. You can buy a piece of any company you want that's public, okay? Not every company is public. A lot of companies want to be private. Walmart is public, but Chick-fil-A is private. The reason why companies go public in the first place is because they want to raise money. They want to give you a piece of their company in order for you to pay them to own that piece. So if a company wants to go public, they have what's called an IPO. An IPO means initial public offering. It's what they offer initially for a share of their company. So if Chick-fil-A were to go public, they would offer $100 per share. You'd pay them that, and it would go straight to Chick-fil-A. So it brings in a lot of money right off the bat, and the company will retain a lot of those shares as well, so that if they want the money, they can sell more. They can also buy it back. But yeah. Companies generally go public, again, to raise money, but with that comes a loss of control. So that's why some companies don't go public, because you're literally selling part of your company, and everyone that owns a share of a company can vote on what the company does. So if they're going to hire a new CEO or something, you can go and vote for that. Or it depends on how the company runs things, but in general, that's how it works. You can fact check me, and please do, on anything I say here, but yeah. So that's kind of what the stock market is. Let me now explain how the stock market works. In 2 words, the stock market works through supply and demand. Let's say that I have water bottles. I have like 10 water bottles, and I'm selling them in a place where there's free public water. Okay? I probably wouldn't be able to sell them for very much because a lot of people would be able to just get water for free if they needed it. But some people would probably still buy it because it gives you that added value of having the water later. Or some people might buy it and take it to somewhere that doesn't have as much water and sell it for more. So that's a lot how the stock market works. If I were in the desert trying to sell those water bottles, the price would be a lot more because I only have 10 water bottles and there's no water anywhere around me. So people would be willing to pay a lot for those water bottles. Okay, the stock market is similar to this. Let's say that I go to the desert and buy one of those water bottles from you, who's selling them, and then I buy all of them from you. Then I can turn around and sell them at even greater cost because now I'm the one that owns them. Okay, this is how the stock market works in that, like, people will, if they think that the company's valuable, if they think that the company's going to produce more money, then they'll buy it, and and when more people buy it, the stock price goes up. Okay? So a lot of things can affect the price of a stock. In general, like we talked about, supply and demand, but in general, people look at the company's performance to see how much the stock is worth. So if you were, every public company is required to file what's called earnings. It's their financial statements. It's their balance sheet, income statement, and statement of cash flows, or some people call the income statement the P&L. There's a lot of different names for it, but this shows how much money the company's making. Okay, the number one thing that people look at is earnings, or what's called net income. Okay, income after everything else is accounted for. So if I look at Walmart's P&L, it'll show how much money they made, and then it'll show everything that they had to pay, like taxes. They had to pay for the merchandise. They had to pay for shipping. They had to pay for a lot of different expenses that I won't go into. They have to pay their workers, right? A lot of different things. And then at the very bottom is this one line that says net income, and that's how much money that they made for that quarter or that year. Okay, that's the number one thing that people look at, because if a company's making money, then that means it's a valuable company and that they might get some money from that. So that's the number one thing that people look at to determine a stock price. But there are other things. For example, if the economy looks like it might take a downturn, that's kind of a hot topic right now that I won't go into. But if it looks like it might go into a downturn, people will sell off their stocks, and that'll cause the price to go down. Right? When no one wants it, the price it's cheaper to buy. So if something really bad happens, like for example COVID recently happened, people are worried that the economy might slow down. These companies might not be making enough money, so they'll sell off their stocks, and those will cause the stock price to go down. Another thing that causes stock prices to change is like news articles or things that come out, or trends. Like for example, like Elon Musk. I forget when this was, but he tweeted out something and it caused Tesla stock to drop. Right, so there's just a lot of things that go into the price of a company. But in general, there are two ways that you can make money from these things. So one way is dividends. That's when they take some of those earnings that they made, the net income, and they divide it up in between all their shares, and they pay out a dividend. And that'll generally be like 10 to 20 cents a share. So it's not very much, depending on the stock. And if you have a lot of that stock, then it is a lot. But yeah, so that's one way that you can make money from a stock. And the other way is through what's called capital gains. So there are some big dividend stocks, but a lot of companies choose not to pay any dividends and to keep their money in their company, so that they can use it to invest in machinery or inventory or whatever it is. So, for example, Tesla almost never pays out any dividends. They'll usually keep it, and because they're keeping it in the company. Generally, their stock will move up because they're using their money to make it better. So a capital gain is just a fancy term for a change in the stock price that's positive. So if I buy a stock of Apple for $100 and then I sell it for $110, my capital gain is $10. So when you buy something, again, you're hoping, and you're probably right, that the stock will eventually be worth more than what you bought it for, as long as you wait for it. So those are kind of the two main ways to make money in the stock market. Okay. Lastly, I wanted to kind of go into what your options are as an investor. So like I talked about, there's individual companies. That's kind of what the focus of this episode has been. And then there's also index funds. There's baskets of stocks. Those are index funds, they're mutual funds, they're ETFs, okay? Just to give a quick little definition of those, index funds and ETFs are both passively managed baskets or groups of stocks. They will generally track a bunch of different companies and then give you one price for that. So, for example, if you buy the S&P 500 is a common index. That's the 500 biggest companies in the United States, all weighted by how big they are. So you'll own more of the number one biggest company than the 500th biggest company. And it'll bundle that up into one share. So if I go and buy one share of the S&P 500, then I own effectively 500 different companies in that one price. The difference between index funds and ETFs are index funds are generally one set price that you can buy at the beginning and at the end of the day. And usually there's minimal to no fees with index funds. ETFs are similar, but you can buy those at any time. They're traded just like a normal stock, so you can buy that at any time of normal trading hours. And again, the fees are very minimal with those. Now, mutual funds are what's called actively managed funds, and those are professional like stock pickers trying to beat the S&P 500. Usually is the benchmark, the S&P 500. If you can beat the S&P 500, that means you're a good stock picker. So most people can't do this in the long run. Now, a lot of people can do this in the short run. You can go through and say, wow, this company looks really good, and they're probably going to outperform the S&P 500 in the next 5 to 10 years. And that's fine, but mutual funds also do cost money because they're being actively managed. People are actively choosing those stocks that are in those. So just be wary of those. If you wanted my recommendation, I would suggest ETFs. There's VOO, SPY, QQQ. Those are really common ones that I would suggest because those are VOO and SPY they track the S&P 500, and QQQ tracks the Nasdaq, which is like tech stocks like we talked about earlier. So if you want my recommendation, that's what I would say. But again, do your own research and choose what's best for you ultimately. If you're in the stock market for a short period of time, maybe a mutual fund is better. But if you're saving for 20, 30 years down the road for retirement, then I would highly suggest doing one of these passively managed things that just track the S&P 500 or something like that. All right, great. So I know that was a lot of information all at once, as usual, but I hope that was broken down well for you. If not, again, send me an email, shoot me a question, whatever you want to get a hold of me. Again, I will link to my cash flow spreadsheet down in the description. This is a great way for you to track your costs and expenses every single month. So you're obeying rule number 1 and learning to invest, things like that. But yeah, let me know what kind of topics you guys want to hear. And I look forward to seeing you next week.